All right. Welcome everybody to Midas Investing Live. Happy Sunday afternoon to everybody out there who may show up live or watching on the replay. Either of which, if you're watching now or later, I would ask that you please give us a like right up front. That'd be really, really appreciated. Really help us get going and help attract more viewers to the channel. And if you're not already, please subscribe to the channel. That's the best way that you can get notified whenever I do go live, which is once a week, as well as whenever I put videos out like my advanced auto parts video, which I put out a week or so ago, and my Smith & Wesson video, which I put out a couple weeks before that. So subscribe and put the notification bell on to make sure that you get notified whenever those videos go out, or like I said, the live shows as we're having here today. So here we have my portfolio dashboard. Not too much necessarily to talk about on the dashboard itself. We had more action last week, really, in terms of kind of changing things around on the portfolio, really just kind of thinking about some of the positions in portfolio, and a lot of the research that I'm going to be talking about here today, having to do with commodities, is pretty heavily related to, I guess, a lot of the thinking about positions in my portfolio that I've been thinking, going through and researching and thinking through. Because obviously, in particular, if you've watched a lot of my content before, or perhaps you're newer to my content, when this will be a little bit of a, I guess, an overview of the topics that we definitely cover a lot on here. But I am pretty heavily interested in the commodity space. I'm very, very interested in real assets in particular. I like commodities for that reason, because I consider them to be very tangible real assets that give a lot of inflation protection under certain circumstances. But they're also very, very complicated. A lot of investors don't like to invest in commodity companies or in the commodity space for that reason. So I kind of consider it like a space that has opportunities for that reason, but there's reasons why people don't like it, which is that has those complications. But nonetheless, I'm invested in a gold miner, which is Barrick Gold Corp. I'm also invested in an agricultural commodity company, that being Tyson's Food, which has exposure to beef, chicken, and pork. I also have Interfor Forestry, which is, as the name implies, a lumber company. And then I also have Samphire Resources, which is a copper mining company that also has some exposure to gold as well. So I do have a decent amount of commodity exposure already. As we've kind of already discussed on previous live shows a little bit, you can go back and find my previous lives where we definitely had already been talking a bit about commodities, in terms of we had talked a lot about oil in this particular live show. I would say that this show here today is in some ways kind of like a part two to a lot of what we discussed in that particular live show. Although we had discussed a little bit more of a follow-up on that last week as well. But this is just kind of a continuing following up. That point being that in that particular live show, I had done a whole lot of work on a commodity model focused around crude oil, which first off, I had showed a lot of information surrounding the industry of crude oil, which I'm not going to do that as much for all the commodities we're going to be discussing here today. It's really more that we're taking the regression model concept that I had discussed, where I had taken a variety of economic factors and regressed them against the changes in oil prices over various decades in order to try to project future oil prices, and then take a sampling of that to see how well the projection lines up against it, and then make a projection for the future, which is kind of what you can see right here. Point is we're taking this concept that we had discussed, like I said, on previous lives, and applying it to many other commodities here today. Like I said, my portfolio already has exposure to gold, and through those gold miners, they also have a little bit of silver as well. As well as I personally own some gold and silver, so I have some exposure in that form as well. But then, like I said, I have exposure to lumber, as well as copper, as well as beef and chicken and pork. And I'm very interested in, like I said, crude oil, which is also related to other energy commodities such as like natural gas. So there's a lot of commodities here that I need to have some sort of understanding of where they're going to go if I'm going to be making sort of projections for them into the future. So the point is I did this same process, which I did with crude oil, over a variety of these commodities, and I actually put them on a separate page here on my valuation dashboard, and we're going to kind of go through the results of what I found here today, kind of one by one. And I did include a few other commodities beyond specifically the ones that I just kind of listed. I also did wheat and corn, which are not specifically in the groups that I just talked about. Like I said, it's really kind of this selection right here are the ones that I already have exposure to. And these ones, I'm not necessarily looking to get exposure to wheat or corn, but those are very, very core food staple commodities that affect a lot of the core prices in a lot of other ways. So I think it's important to kind of have an idea for them. And I'm looking to take a look at modeling a few other commodities as well, perhaps iron, perhaps uranium as well. I just didn't quite get around to. These are the ones I basically got around to through the rest of yesterday before I was kind of when I was preparing for this live show. So anyway, back to the crude oil model. When I first showed this model, I had said that the only economic factor that I had successfully gotten to correlate well with the model was city urbanization rates, which is the portion of the global population that is living in cities. And what I meant by that, as I had explained at the time, is that I'm looking at the way in which an economic factor changes over one decade. Say this is the 1980s right here. So over the 1980s, how did the city urbanization change over the 1980s? And how does that affect the oil prices in the next decade, being the 90s? And so it's this kind of forward corollary effect that I'm searching for. It's easy to find something that correlates well with a commodity at the same time. That's not that difficult. It's hard to find factors that correlate well with years forward. But then I eventually decided to layer in this concept of this like decade forward correlation search for different factors with other factors that I already have a sort of reasonable projection that I can rely on for the future. One good example of which would be population. There's good government projections for where the population is going to go over the next decade that I feel reasonably confident I can rely on their projections of where it's going to go for the next decade. And since population correlates directly with oil, then I don't necessarily need to do this 10-year forward and backward correlation effect if there's a forward projection for population. So the point is I decided to layer in these direct factors with also some forward factors in different ways. And then so with oil in particular, I layered in the population, the global population, as one direct factor. And then like I said, I had previously been using urbanization as a forward factor for oil. But I actually changed that in the last week after I found some different factors that work even better when combined in different ways. That being the growth of the US M2 money supply, the US productivity index, as well as the S&P 500. Now I did try different global versions of these measures, as well as more broader measures of equity markets, such as like the Wilshire 5000 instead of the S&P 500. My choice in these particular factors, or focusing on US factors over global, was specifically because it gave me a better statistical result. And so in general, the point is I was trying to make the models work better. And so I opted for the factors that worked the best, as long as they weren't conflicting with other factors that I had used, or as long as there wasn't any sort of circular relationship between the factors. And I bring up the circular relationship between the factors because as I move down the list, the point is I started with oil, and that means by the end of the process, I had a projection for oil, or at least assuming I managed to successfully get it within the model range. The goal is to have at least 95% of all of the historic points, which is the blue lines through this point right here. At least 95% of these points fall within give or take 2 standard errors away from the predicted range, which for oil, you can see that works out because there's only 1 point outside of the range. And that means that we have approximately 95% inside the range. In fact, if I come over to the value dashboard and check, it actually says that there's only 4% outside of the range based off of that. So the point is that means oil is actually a pretty statistically reliable model. And so if I actually have a forward projection for oil now, that means in some of the further projections I do down the list, I could use that projection for oil as a direct factor. So that's something I'm going to continue to do in here. For example, for my projection for gold, I use my projection for oil and my projection for copper, because copper is another one that ends up 5% or less, as you can see right here. In fact, I guess I'll point it out right here, since we're looking at the chart. You can see the ones that are green right here show which of the models end up being successful, meaning 5% or less of points are outside of the range, that being oil, copper, and lumber. So those are the most robust of the models that I managed to produce here, is basically what I would say there. I do have projections for gold and silver, as well as the beef, chicken, pork, wheat, and corn. but I would say that those models ended up being significantly less reliable based on the fact that there's more points outside of the range than we were hopeful for. In general, two. If it was more than two, I generally kept working and working, trying to make it better until I got to no more than two outside of the range, if that was what was required. For some of the models down here, we actually had a smaller sample size, which meant even 1 point outside of the range was going to make it more than 5%. So unfortunately, some of those were less likely to be successful based off of that basis alone. So coming back over to take a look at it, as we were kind of just talking about the oil, so you can see this is what a successful model for the oil looks like. We'll come over and take a look at copper now as well. This is the copper model as it comes out to be. You can see right here that there is 1 point that falls outside of the range. There is 5 points that fall very close to the range edge, but they're inside of it just barely. So that means that the model works, because it doesn't really matter how close it is to the edge of the range as long as it's within the range. Just the 1 point outside of it. So nonetheless, we have a pretty good projection for copper. And I did kind of breeze past it. That's because I was going to talk about the actual data once we get to looking at just like the table. I have all of it right here. But I guess I will at least mention that the predicted value for oil ends up being now $75.93 per barrel in 2032. Now, in my previous live where I talked about oil prices in particular and a lot of data related to the oil industry, I also said that I didn't want to rely just on these regression models that I made, and I wanted to also take in account other predictions being made by other institutions. And so I took in a variety of estimates being made by, for example, the IEA, the IMF, the World Bank, the National Energy Board, McKinsey Institute, and Deloitte & Touche, which gave me a variety of other prices. And then I composited my estimates along with their estimates into a distribution of prices right here. And then that was what I was going to use whenever making valuations around oil companies. I'm going to do this same process where I take into account other estimates from other places for the other commodities as well, but I didn't get around to doing that this week. So that's going to have to wait until I'm looking to use that information for the future. So it's worth noting that while I do have my estimates for these other commodities, it's very possible that once I take into account other economists and analysts' estimates for the future, that their estimates might be significantly lower or higher than mine. And so once I average in mine with theirs, it's possible that the estimates I'll use for my valuations will be a bit different for that reason. But nonetheless, we're just talking about the regression results today. So take that for what it's worth. For example, the weighted average estimate for when I take into account other estimates for oil is 79.61, whereas my regression estimate ends up being 75.93. So in oil's case, taking into account other people's estimates actually gives me a slightly higher price. Like I said, for the other commodities, there's no telling which direction it'll go. It might be a little bit different. But for copper, the regression output currently as an estimate for 10 years from now is $5.21 per pound. Possible that the analysts or other economists will give a slightly lower estimate, maybe possibly higher too, but I don't know. The point is take it for a grain of salt until I've actually done that research. I didn't get around to doing that type of research for every one of these commodities this particular week. They'll have to kind of wait until I start applying this information to my own companies, because I haven't done that either. I haven't taken and adjusted the companies that have these exposures to various commodities and applied it to those valuations yet either. That'll be work for this week, basically. So taking a look at copper, as I said, we'll take a look at now the factors that I actually ended up including in this particular grouping. For copper, it ended up being a global population for a direct relationship. As I said, direct factors are pretty much more easy to automatically apply. So the global population one will be used for the majority of these. Obviously, some of them it doesn't apply very well to. But for copper, global population as a direct factor works well. Real U.S. housing as an index ended up being pretty much the only factor that I could find that would work on a 10-year forward regression basis, which was pretty interesting. I tried tons of factors trying to get copper to work. Copper was probably one of the most tricky one of these to actually get to work on a what type of economic factor in this decade affects the copper prices in the next decade. And US real housing costs, meaning adjusted for inflation, was the one factor that I found to work out well with that. And so with that one factor combined with a direct relationship of global population, I did end up managing to get an actually reasonably viable relationship for copper that has all but 1 point fall within the range. which is pretty neat, considering it was only relied one. And one thing I did find about these regression factors is that there isn't necessarily some super direct relationship between how many factors use and how useful the model is. I use as many or as little as necessary to get as good of a relationship as necessary. I wanted to use as few as possible in general. I wanted in general to have at least 2 forward factors and then maybe like 1 direct factor, and that would sort of been maybe the ideal size. But some of these I ended up using like 5 or 6 factors, and then other ones like the copper I ended up only using 2. So it's like it's a little bit kind of random how many factors ended up being used, because like I said, I was sort of fishing for the best statistical relationship when making these relationships. Jack, dope, thanks, I appreciate it. took a bunch of work. So anyway, like I said, copper, just global population and US real housing costs. And when trying to decide 4 factors, it's worth knowing that I only generally relied on things that I thought made sense from a rational basis. The idea of this is to choose something where there's a real logical basis for it to exist, and then you look for the statistical information afterwards. You start with the rational and then you search for the empirical. Technically, that's the scientific method. Would copper be correlated with clean energy use, i.e. solar and EVs? It probably would. I don't know if you caught the earlier case statement I made, that it's actually not that difficult necessarily to find things that correlate well with commodities in the direct decade that you're looking at it. Like if I want to see something correlate with copper prices in the 90s, but I compare it to another factor in the 90s, it's usually not that hard to find a relationship. Copper is actually highly correlated with most economic growth in a variety of other ways, which is where it comes down to why, for example, I'm going to use the copper model to build up some of the other models, because it's actually going to be a useful factor when making projections for other factors. So I would say yes, copper probably would be correlated with clean energy use, but you probably wouldn't be able to use it as a factor to predict copper prices, on a forward basis, which is kind of what I'm doing here. It would probably be more like the other way around. You could probably use copper prices to predict clean energy use, because of the fact that the costs of those inputs is going to affect the demand for those products, which is exactly how it's going to affect some of the other factors that I was talking about. Like copper, you can use copper to predict lumber prices because of the fact that there's going to be so much copper in the houses, and the lumber prices are going to go into the houses as well. So you can use some of these factors in some directions, but not always necessarily in both directions. So anyway, moving on to the next one on the list, I have gold, which gold for direct factors, I use pretty much all 3 that I had available at that point, which being the global population, oil, which because now we do have an oil target to work with, as well as copper, because now we have a copper target to work with. So I used all 3 of the forward factors that I could use for gold, but then I also use global population as a forward factor. So you can use both as a direct and a forward factor. There's no problem necessarily using it, because technically it's 2 separate processes that are kind of being averaged together. But then I also used reserves per capita. Now it's worth noting this reserves isn't mining reserves. This is specifically government gold reserves per global capita. And that actually has a pretty significant effect on the gold price, which I think makes sense because it sort of relates back to the public's perception of how likely is the gold is actually going to be used internationally as some sort of money substitute, and which might affect the demand for the product in the next decade or so. But then copper, like I said, we can also use copper. In this particular case, it's being used both as a direct factor and a forward factor. But that makes sense because copper is going to affect the costs of a lot of industrial materials and industrial equipment as well. Industrial equipment like mining equipment. So that's going to be an input cost into a variety of other things. So the thing is, like, copper and oil are really, really useful for making predictions on other commodities, just because of just how useful both of those are as core inputs to so much economic activity. So you'll see that popping up a lot here within this model. So I will say with the gold model, however, we do not successfully manage to get it to 5% or less of a failure rate. We do have 2 points falling outside of the range. So coming over to the gold projection here, comparing it, for example, to the copper one, you can see the copper range, I have it 2 standard errors away, but we show 1 standard error within the range here in this kind of orange color to kind of, which, because if we manage to have 5% or less outside of the range, that means we can actually make a statement about the inner range to say that there should be about 50% of the points within the inner range. Since more than 5% falls outside of the outer range on the gold model, that means I can't actually use the inner range with any sort of statistical confidence. So instead, we just rely on the outer range. And in fact, since it still has this error of more than 5%, we actually adjust the range downward by 1 standard error to be more conservative. Technically, it could be to the upside as well. The uncertainty technically cuts both directions, but I'm going to adjust it downward to be more conservative. So that means that essentially, because of the fact that there's 2 points outside of the range with this many points available in our sample, then my estimate ends up being adjusted downward from this point of almost 3,200 to downward to more like 2,900. But either way, a range of like 3,500 at the top end to possibly 2,300 on the bottom end. But the midpoint being 28 to 2,900 or so, and that being for gold. And likewise, I already talked about the factors for that. Silver also has more than 5% of the points falling outside of the range, so it's going to have that same error adjustment downward that the gold does. It's going to be the same for basically all the ones that don't have the green in this box here. So an error adjustment is made for gold, silver, beef, chicken, pork, wheat, and corn. And as I said, technically that error adjustment could cut to the upside too, but I'm choosing to make it to the downside to be more conservative. And hell, if I can find better factors to make these predictions in the future, I'll try for it. I tried many more than just these factors you see listed here. I tried like 30 or 40 different economic factors. I tried various forms of economic growth, various forms of real wealth growth, various forms of money supply growth, all sorts of things. I tried all sorts of different factors. But in general, I didn't want to rely on something that was too narrow. It was generally very broad macro or global factors that I tried to rely on. But nonetheless, these are the things that end up giving me the success that I got. So moving on to silver though. With silver, global population, funnily enough, was not actually giving us statistically viable results, while oil and copper continue to. So it's a little bit different than for what we did with gold, where we just have those two. Like I said, we just used what worked. We didn't necessarily fuss about what did or didn't work. We just used what worked. And the funny thing is, it didn't work as a direct factor, but it did work as a 10-year forward factor. So it just goes to show that like those are two totally different processes. They don't necessarily imply the same thing. It's like if the population growth in one decade might affect the products that are going to be demanded in the long run based off of the supply of those people, but it's not necessarily going to have the same sort of effect as a short run corollary, because that's more like taking into account different people at different parts of their life cycle, if that makes sense. But anyway, alongside the global population as a forward factor, we also have US productivity working out really well as reserves per capita. Now, this is the interesting part because it's not silver reserves per capita, it's gold reserves per capita. Now, I'm choosing to allow this to actually continue to make sense and to work because of the relationship that gold and silver have to each other. If it wasn't for the relationship that gold and silver generally have to each other, which is that people actually often price gold relative to silver or silver relative to gold, for better or for worse, because, you know, for the most part, gold it still is thought of in various circles in various parts of the world as money, but silver, I would say less so. It's maybe moved away from that kind of perception a little bit more than gold has, although again, depends on who you talk to. But the point is it had a surprisingly strong correlate factor. So I decided to leave it in just because I still think it kind of relates back to people's perceptions about whether or not these two materials are or not considered money or money substitutes. But copper also, as a forward factor, still correlated relatively well for the same reasons as I explained before, likely mining equipment and the inputs to it. And with that got us to our outputs for silver, which will come over to the silver model. And this is what we ended up getting. As I said before, it's adjusted downward by 1 standard error. And the output we ended up getting was about $31 per ounce for silver, but then it's now adjusted downward to $26 per ounce with a pretty wide range, but nonetheless, and this one, yeah, a little bit more flattish in terms of what its actual directionality. So is what it is. That's one thing about this is that this process is driven by my my rational basis for why I would include these factors. But then past that, it's entirely driven by the statistics. It's entirely driven by what the data gives me, what direction these things go. If it just happens to be some of these commodities end up having significant growth ahead of them based off of these projections, and some of them seem to be relatively flat. That just kind of is what it is. But we'll get to an overview of the actual I guess expectations of that once I kind of finish going through the factors that I included here. But moving on to lumber being the next one in the group, which, like I said, lumber does manage to come out with less than 5% of the points outside of the range. So we would say that the lumber model is pretty reliable, which is pretty interesting considering I would say that it has some significant growth attached to it. But anyway, we'll look at that in just a moment. Direct factors, oil and copper, worked out pretty well. Population didn't work out as well as a direct factor, so that is what it is. We chose to leave it out. In terms of the forward factors, global urbanization worked out pretty well for this one, which is pretty interesting. This one worked out well, but the global population as a forward factor didn't work out very well, because usually when I was looking at the relationship between global urbanization, generally if this worked, but one of them might work better than the other. And so that might have decided which one I ended up using. But so a little bit interesting that this is the factor that ended up getting used here, whereas neither the global population for forward or direct ended up getting used. But like I said, we basically just followed the statistics and went where it did. But US M2 growth had a pretty significant effect on it as well. US productivity had a pretty significant effect on it as well. Forward effects of oil had a significant effect, as well as forward effects of copper. So as you can see here, lumber, we actually used a pretty significant pile of factors. What is that? 5 forward factors plus 2 direct. So a pretty large array of factors there to get a pretty robust model. Whereas, like I said, with copper, we only use 2 factors total. And still have a robust model. So that should go what I was trying to say is, like, there isn't really a relationship between how many factors get used in the model and how good the model ends up coming out. It just is what it is. You know, some of them, they got better as I added more to it. Some of them, it got better as I cut elements out. That just is what it is. And also down here, while I'm kind of talking about it, I've been talking primarily about the failure rate, which shows how many points fall outside of the range relative to the historic data. But I also have here the R squared, which the way you can kind of think of this is that this shows how accurate you are, and this shows how precise you are in a sense. Because the R squared basically says how related are the actual movements of the model to the movements of the historic data. And this says, well, let's talk about the points themselves. Are the points themselves inside the expected range? And so that's kind of what the difference between these two columns here. And so you can see that the R squared, in general, you want a high R squared. You want a low failure rate, but you want a high R squared. And if you see here that there's a pretty significant kind of unrelationship between them. You might have a high R squared with a low failure rate, but you might also have a low R squared with a low failure rate, and vice versa. And I kind of checked that out here. You can see that, yeah, there's basically no real correlation or relationship between the R squared and the failure rate. They basically have no direct relationship between each other. Which is kind of similar to what I was saying before with the other factors, is that there isn't necessarily a direct relationship between how many factors get used and how good the model ends up. And that's basically to say that because each of these commodities are pretty independent of each other, they don't necessarily relate to each other other than in the relationships that we've kind of identified here. So moving past lumber, oh wait, no, I didn't actually show the lumber. We didn't actually get to the lumber. So now taking a look at the actual lumber model, this is how the lumber ends up coming out to be. Here's the lumber points, and only 1 point falls outside of the range. This one barely falls in the range, but as I said before, it doesn't matter how close it is to the edge of the range. It just matters that it's inside the range. So 1 point falling outside the range means over this length of time, that makes it a statistically robust model enough to give us a projection out to the future of about $13.10 or $13.11 dollars per board feet. I did adjust this historic data to the most recent contract change. Anybody who has been paying attention to the lumber space might know that they recently did a futures contract change, changing basically the order size for the board feet, and that changed basically the price that's being reported for the lumber future contract. So if you looked at it basically like 3 months ago, it would look like the price jumped like 60-70% or something within like a day or two. I've seen a lot of historic charts out there that aren't really adjusting for this correctly. And then other charts just show the most recent contract. So it might look like it literally just started a few months ago. But the point is I'm using the most recent contract data here, and I adjusted my historic prices to that more recent contract price. So if you're thinking about lumber prices, try to make sure you don't get it confused. This is the LBR contract, not the LB1 contract being reported here. Kind of important. Like I said, recent changes confusing a lot of people in the space. Anyway, so moving on to beef, chicken, and pork. With my exposure to Tyson, I wanted to get a coverage for this. There's some caveats I kind of need to mention about these ones as well, which is to say that beef, I'm using the global beef price being listed by the Federal Reserve as my data point, which I'm listing here, which they show as being about $2.30 per pound as of June, which is the data that they have here. However, if you go and find data on, for example, the live cattle futures, it'll be a slightly different number in general. That's going to be a little bit of a lower number. But the point, like I said, it's basically like apples and oranges, but very, very closely related numbers. So the point is, if you're looking at like the beef futures, which is usually like a live cattle futures contract, then it's going to be a different price. I'm just going to point that out here. It's not exactly the same as the lumber situation where I was actually able to adjust it. This is one where I didn't adjust it because it's actually a totally different thing. So you just have to be aware that what I'm reporting is a global beef price, not a cattle price in particular, which they're very, very closely related, but not the same. Highly correlated, but not the same. So keep that in mind. But anyway, so with that though, global population as a direct factor works out pretty well. For forward factors, global population also continues to work pretty well. Global urbanization works pretty well. What was it? U.S. productivity works pretty well. And oil prices as a forward factor work really well. And then one factor that we haven't used yet starts getting introduced, which is that the US dollar index, the DXY, starts working really well. And something I'll point out here is that it starts working really well for all of these agricultural products, in particular agricultural products that the US does a lot of production of. So I think that should make a lot of sense as to why the dollar index starts being relevant here, because it's going to be super relevant to a lot of exports. So anyway, interesting thing I just wanted to point out there. But yeah, so we end up that's the array of factors that we end up using for beef, which, like I also pointed out, unfortunately, for all of these agricultural products, basically the rest of the models are going to be relatively less effective. In fact, they're in general, some of them are even less effective than some of the other ineffective ones we have here, which partially comes from the smaller sample size of data points that we have. Unfortunately, it just is what it is. I have a smaller sample size of information for some of these. But anyway, getting on to that, we can take a look at the beef chart. This is the beef prices over the historic period. And you can see that we end up having 2 points fall outside of the range, a couple pretty close to the edge there, but still just 2 outside of the range, which, I mean, I would say it's like, I don't know, it feels like it's less volatile in a certain sense. So maybe a little bit easier to track in this sense. Oh, one thing I didn't actually state from the very beginning, which I probably should have stated from the very beginning, the historic prices being listed here, these are annual points that we're doing the regressions from. So it's annual changeovers that is the point, the information being used in the regression, and we're using annual averages for each of these prices. And that's true for all of these. I didn't actually mention that, but that's probably something I probably should have mentioned from the get-go. All of these are the trailing annual price for every single one of these models, because that's basically what I'm trying to figure out. I'm trying to say is like, what's the average price going to be 10 years from now? Now, I don't really care what one individual price that trades at one day is going to be. I want to know, right, like what's the average price? And so all of these correlations are being done with the average annual price trailing at each of these points. So something I didn't mention before, but I probably should have mentioned. That somewhat, by the way, explains why these charts look not as volatile as you might expect. That's why I probably should have mentioned it. It's like some of these maybe don't look as chaotic as they might otherwise look, because it's only 1 point per year, and that point is an average. But anyway, so on average, we still have 2 points outside of the range for the beef here. The rest of it still falls within the range in general. We adjust downward because of the fact that we still have 2 points outside of the range, and that gets us to about $4.83 per pound for beef in 10 years or so. Moving on to the next one, we have chicken. Global population as a direct factor works well for chicken. Global population as a forward factor works well for chicken as well. Then we also used oil again, and then we also used the DXY again. In general, the beef, chicken, and pork ones all work pretty similarly. There's not too much difference between those. I found similar factors to work pretty well for all three of those, which is, saved me a lot of time, I guess you could say. Although at the same time, like I said, they didn't end up getting as good as you might have liked them to be. But the point is the factors worked out pretty well. But anyway, come over to the chicken chart. You can see, just 1 point there falling outside of the range, which is only 1 point outside the range. So you might be like saying, oh, well, why doesn't it count as a robust model? Well, like I said, it's a relatively smaller sample size. So this chart only goes back to 1990. The regression only starts at 2005. So this sample size is much smaller, which means 1 point still counts as more than 5%. And so it's not about it being 1 point, it's about it being 5% or less. That's actually what matters. So the point is unfortunately, for this sample size, I would need it to be 0, unfortunately. So it gets adjusted downward to about $1.94 for chicken. And it's also worth noting that somewhat similarly with the beef one, I didn't pull it up, but this is actually a global poultry price. So technically it's a little bit more of a broader thing than chicken, but again, highly correlated. And I like relying on the Federal Reserve data. That's just something I personally do because I prefer to take their data over many other sources since they report in a much more official fashion. On to pork, global population works. For this one, oil as a direct factor works, whereas for beef and chicken, that one wasn't working very well. So interesting, that one has one extra factor where the other two didn't. Global population as a forward factor continues to work. Oil as a forward factor doesn't work here. So that's interesting. It comes back to what I was saying before. It's like, it's kind of interesting and kind of strange how some things work and some things don't. Oil as a direct factor works for pork, but it doesn't work as a forward factor for pork, whereas it did work for both beef and chicken. But the DXY still continues to work for this one. So interesting how that one plays out. But nonetheless, we still end up with more than 5% of a failure rate for that one. Coming over to the chart, it's also starting in 2005. So that's part of the problem, 1 point outside of the range, but again, 2005. So too small of a range here. This is the range we end up getting. And we end up with a projection of about 83 cents for pork. Likewise, you can find futures for pork. In general, the future contract you find is specifically for pork chops. This is also a generalized pork price, which is going to report slightly lower than the pork chop price. So keep that in mind. It's going to be slightly different things. If you're not paying attention to what you're looking at, it can be apples and oranges. Moving on to wheat, we end up with one that also still not as robust. Neither population or oil worked for wheat as direct factors, which is kind of interesting. Copper ended up being a pretty useful factor as a direct factor. And then real US housing popped up again, which is kind of interesting. I kind of went back and forth on whether or not I even wanted to include this one because I thought that it didn't necessarily have the greatest of rational bases for it, other than to say that like wheat takes up a lot of real estate and so does or a lot of land, and so does housing real estate. But that doesn't really make too much sense to me because I think that the housing actually is much more affected by other factors. So it's like, it seemed a little bit strange to me that I had there, but I decided to include it because, like I said, I was kind of trying to be driven by the data and not necessarily by my own intuitions necessarily. But I also included copper and the DXY, those ones both having pretty significant effect on it. Coming over to wheat, you take a look at wheat, we're back to having a little bit more of a longer range again because I can get more of a longer futures data for wheat, which is kind of useful. And unfortunately, we still end up with 2 points outside of the range, even though we have a longer set of data. So that means we do have to error adjust it downward to 625 per bushel for wheat in 10 years, which puts it significantly lower than it actually currently is, or on average was last year, this being one of the ones that's going to tread more water, it seems like, according to our process here. And then last but not least, we move on to corn. That's the last of these. And then we can actually kind of talk about like the actual price returns or compounded returns expected and how that relates to inflation, as well as the companies we might be interested in, and both of those things. But corn, we have oil as a direct factor, copper as a direct factor, and then we have copper as a forward factor. And then this one, the DXY, actually didn't work out very nicely for, which I thought was kind of interesting. That was like the one of the livestock and agriculturals that didn't like the DXY. Very, very interesting. But whatever, it is what it was. Didn't argue with the data. came over to it, and this is what we ended up with. We have a pretty large, a larger set of data going back to the 70s, like for this one as well. Unfortunately, however, we end up with 3 points outside of the range. So this one actually is, in a sense, the worst performing of the models. So I guess you can take that with a grain of salt. Oh, I see this. It still says weed up here. My bad about that. Change that title on there real quick. Didn't realize I changed that, or didn't change that. But anyway, so yeah, is what it is. But that gets us to $5.07 for corn in 10 years. So coming over to the dashboard again, that's pretty much the overview of all of them. That's a whole lot of commodities. Like I said, I pretty much have a whole basket, really. I mean, it's a pretty wide basket. In fact, once I realized how wide of a basket that I had made here, you could include lots of other ones. I'm missing some major ones like iron. Like I said, I kind of have some interest in doing uranium at some point. That's not really a major one. Maybe molybdenum would be missing from here. Might need to get platinum or something. There's a variety of other ones I haven't included. Soybeans isn't on the list. But the point is, it's a wide enough array by category that I was like, ooh, why don't I go find those weights for the actual commodity index, which I did. And then I distributed the weights accordingly by category into here. And then I decided to take a weighted average of the compounded annual expected price returns for each of these, and then weighted them together to get a weighted assumption. Now, I do have it listed from 2 points here. I have the current price, the most recent price that I have for each of these here, and then I have the COGR to the predicted price that I have. The predicted meaning it's the error adjusted one for the ones where that's relevant. But I also have the 2022 end of year average because that's the last point on my charts. As I had said before, it's like these are all yearly averages, and it's the 2022 end is where the regression is taken from because these are yearly data points. So the point is, I chose to also include where the price was basically at the last data point, so that you know where the price was from where it made the prediction. Because I think that's kind of relevant. It's like this is basically the last price from which it made the prediction, and this is the prediction that it came up with. But this is the most recent price that they actually traded at for each of these that I could find. So you can take that for what it's worth. If you're going to be buying into anything related to these commodities, this is the price that's going to be kind of relevant for you, right? But for understanding, I guess, my model, I wanted to include this information here. But nonetheless, like I said, we have the compounded growth rates here. I marked them red if they were negative, and I marked them green if they were more than 3% compounded. Basically meaning it sounded like significantly more than 2% was basically kind of the logic behind that. So it's kind of interesting how it plays out. It's like oil looks like it's expecting some declines. It was expecting lots of declines from the end of last year, but now it's come down to 80. So it looks like maybe it's closer to about flattish, but maybe still a little bit more in general declines. Though, as I had said at the start, if you take into account some other economists and analyst estimates, then the average predicted price comes up closer to maybe like 79 or something like that. So there's some reason to believe it could be a little bit higher. And like I said, I plan to maybe do that process, go look and find analysts and economists estimates for all these as well. But the point is, I literally finished up on all of this late last night. Like, you know, I'm often doing whatever I'm doing, preparing for today, the day before, or the day or two before. So it's like I didn't have the time to do that part of the process, but I probably will do that part of the process as I apply these to my own company's valuations in the future. So take that for what it's worth. But anyway, with that, oil expecting a little bit of declines. Copper looks like it's expecting some moderate growth, more than 2%. It just barely doesn't make that 3% line. So I would say it's like actually pretty significant growth. It's trending relatively flat from its end of the year point. It's been kind of chilling. I will say that's definitely been how it's been feeling, being owner of a copper miner currently. But we're expecting it to grow significantly, so faster than the current expected inflation rates over the next decade. That much is to take into account. The market set expectations of inflation over the next decade is about 2.25%, or maybe 2.5% if it's moved up a little bit in like the last week. But I haven't checked, so I'm going to assume it's still about 2.25%. Of course, I assume it's probably going to be a little bit higher than that myself. I personally think it is going to be possibly closer to 3% over the next decade, but whatever, the market's at 2.25%. So this is saying higher than that, perhaps. Gold, we're seeing a little bit higher than that. At the end of the year, it was closer to 1,800. It's now trending a little bit closer to 2,000. But either way, regardless of those points in time, that sees it going up a little bit higher.
Silver, we're seeing it a little bit more flat. We saw it's having some legs a little bit towards the end of the year, but it actually has risen a little bit this year. So perhaps it will be closer to flat or trending relatively low for the decade. And then lumber, we actually start to see some interesting action. It was much higher towards the end of the year, although again, this was a yearly average. So this is what the average was last year, is close to 1,000. So it was not necessarily looking at like it was going to have crazy gains relative to that. However, it has dropped dramatically since that point, since the averages of last year. It's currently trading closer to 500. Again, the more recent contract is the one that has to be taken into account here, and those changes have been taken into account in my estimates here. But the point is from where it's currently standing, we're expecting closer to 10%. So lumber looks like that's possibly one of the ones to pay attention to. It's worth noting I already have significant exposure to lumber. That might explain why. And also, you know, I hadn't done this process when I had made those valuations. If you go watch my most recent Inter4 valuation that I did a while back, which I highly recommend people watch it all, when it gets to the part where I talk about lumber prices, I use a much more simplistic, just kind of long-term trend of momentum in when I make those projections. I don't think I necessarily come up with that different of a number, but the point is I basically say in that video that you should kind of take my estimates with a grain of salt, but it should basically be based on the assumption that you're assuming demand for wood and lumber as a product for homes isn't going to change that significantly over the next decade. That was basically what I said. I feel comfortable with these assumptions under the assumption that there isn't going to be some major substitute for lumber spike up suddenly out of nowhere in the next decade. That might have been a big assumption, but the point is this process totally different. We're just relying on changes in oil, copper, population trends, money supply trends, US productivity trends, as well as, I already said oil and copper, but to oil and copper again in different ways to make these predictions for this one. So it's a totally different process that gets us a somewhat similar answer. And I, weirdly enough, feel much more confident in this process because it's much more data driven rather than just kind of feeling driven, if that makes sense. But with beef, coming out of beef, this one also has some significant legs to it. It seems looks like our expectations is that beef prices are going to go up and just continue to go up. Definitely something to pay attention to. Chicken looks like it's going to be a little bit more of a laggard. It's come down from where it was at the end of the last year, but it looks like maybe it won't necessarily go that catastrophically high relative to that. And again, this is long-term trends. So there might be momentary spike ups or something like that. I don't know. And then pork looks like it's actually set for potential declines over the decade, along with wheat and along with corn. So like I said, I weighted all these together based off of the commodity index weightings that currently exist from 2022 using the S&P commodity index. And based off of where it was that the averages of last year, we were expecting deflation in these commodity inputs of almost 1% compounded per year. Now, after we've actually had a significant amount of disinflation in our economy, where they currently stand, we find it to be more like 1%, which I think this number actually makes sense because you would actually expect this number to be a little bit lower on average than what you're expecting for inflation. If you're expecting 2% inflation, maybe you would expect 1% for commodity inputs. If you're expecting 3% for inflation, maybe you would expect 1.5% to 2% for commodity inputs. In general, if you look at like the PPI versus the CPI, there's generally a little bit of a differential between the two. And so it's like, I think this number makes sense. It's like I said, it's a little bit lower than my own personal feelings about inflation. I personally feel like 3% is a better number. So maybe under that in circumstance, you would expect it to be closer to 2%, or 1.5%. This seems maybe a little bit low if I feel like 3% is the correct inflation number, but I don't know. I didn't include all of the commodities here. I also did a risk adjustment to my predictions for a lot of these. And as I had said, that risk adjustment would be just as logical to go above as it is to go below. So it's really just conservatism that made me do that. So it's possible that if I didn't list the conservative predictions here for the ones that didn't have as successful of a model, that we actually would have more like 1.5 to 2% here. And then that would actually make more sense. But like I said, for making valuations, I'm much more comfortable using a more conservative estimate. So that's my commodity predictions. Here you go. Here's their current prices. Here's my predictions for them. Here's the compounded expectations I have for them. Like I said, several days worth of work, several days that were basically following up on several weeks worth of other work that I had kind of been slowly working this model in. It started with me focusing on oil, and then once I had kind of a workable framework for how to make these models, I was like, well, why don't I apply that to all the other commodities I have exposure to, which I did. And then once I had did that, I was like, well, let's start working on some of the other ones I don't even have exposure to. And so that's kind of where we are today. So that's pretty much everything I had kind of planned to discuss here today in terms of that particular discussion. As I said, I'm going to be taking this week probably to apply a lot of this information to the companies that I own that are relevant to this. So like I do own a lumber company and I own a copper company. Copper company in particular, I've definitely been kind of trying to decide what I want to do with. It's a company that I had much higher estimates in terms of revenue and margins for when I first invested in them, and I've gotten more conservative with them over time, which has brought my valuation down a lot more, which has made me decide not being less sure about whether or not I want to keep holding them. I do want exposure to copper, but I don't think that this valuation is necessarily as rosy anymore. Not that I have a better alternative, because the other copper players that I've looked at have also been generally a bit more expensive. But the point is, I think the estimates I was using in those valuations was a bit lower than my now current estimate for copper. So I might be able to raise those valuations a little bit more if I take these higher estimates into account, perhaps. So we'll be taking a look at that this week. I'll be taking a look at the lumber one, though the lumber one was already looking really good already. So I think that's really just going to bolster my confidence on that one a bit more. I'll probably be readjusting my Tyson valuation as well. This one has also been kind of floating around fair value, which I think maybe it might be getting a little bit of an upgrade with that in mind. But I also have been trying to find an energy company. I have been covering energy companies quite a lot. When I first did my model surrounding the oil price, I did do a whole screening process for coming up with companies that I was interested in the energy space, which led to me doing some basic valuations on some of them, which I then have been building a more robust model for one of them in particular over the last week. So I did build a model for Baytex, and it's now been moved over to this valuation page. But I did end up bringing the valuation down significantly in the process by going into the details, into the weeds, and building a more robust model around their production. And ended up finding reasons to believe why my more rosy assumptions previously were wrong. So the point is I think it's closer to fair value now, and it's only at fair value because it's also come up a lot in the last couple weeks. So unfortunately, if I had pulled the trigger right when I found Baytex, I would already be up like 25% on it, and it would be around fair value, and I'd be comfortable. So whatever, you take too long, you snooze, you lose. It is what it is. But it jumped 9% on Friday, so you know it could come back down 9% in a day too. So we'll be keeping an eye on Baytex. But the point is the estimates I used for oil in this one were a little bit different than the final estimates that I had over here. So I might still have some adjustments maybe to make for that one too. Keep an eye out. It's possible that will maybe be the next video I do. I haven't 100% decided on that, but I might do a video on Baytex next. So we'll keep an eye out for that. But yeah, beyond that then, but then I also have Barrick. That's another one that I've been adjusting a lot recently. But now I have even more different estimates for gold than I had than my most recent adjustments I had done for it. So the point is I'll have to adjust that one as well. Likely going to be upgrading it a bit. It itself I have found to be generally a little bit overvalued for a while now. I've been continuing to hold it because I kind of almost think of it as like a strategic position in some senses. But now that I have more higher confidence in higher prices, I can probably raise those estimates a little bit, but that'll probably bring it closer to, I think, fair value. So that is where it is. But I will be looking for other energy companies. I do have the other energy companies that I had on this back page here, that being Cord Energy and Parex Resources, which I might continue to look at both of those a bit more. Parex looks still maybe a little bit enticing. But I was also interested significantly in Canfor, which is another forestry company, with my now even more higher confidence in lumber. Might take a further look at them, even though that would mean even more exposure to the lumber space, and maybe I'm a bit tapped out in that space. I'm not sure, but we'll see about that. So I mean, that's pretty much it for commodities. We can maybe take a look at some other tickers if anybody in the audience has some tickers they want to take a look at. I don't know if Jack is still there or not. I see a few of you are there, but you guys have been relatively quiet today. Or I can just ramble about some of the other things I'm playing this week. We are close to an hour, so maybe not too much. Hey, T. Oh man, I've been hearing all sorts of negativity surrounding it. I haven't been paying super close attention. I know they had their earnings come out recently, and it sounded like they had better numbers than somewhat expected. But that's kind of following up on months and months and months of negativity. Maybe I'm not 100% right on that. Let me pull it up. I thought I heard that they had a beat on their earnings. Okay, yeah, so they didn't quite make the revenue estimate, but they beat slightly on the earnings. Bounced up a little bit, but yeah, definitely been down, down, and down for the last several months. That's definitely about right. Go you. I don't think I've even heard that one. We'll pull it up maybe here in a second though. Analysts are expecting them to eke out into stable growth. Stable meaning 1% growth for the next couple of years at least. It's better than expecting 1% declines for the next few years, so that's what I expected. Have they actually improved their trailing? Not really. Or their cash flows. What did their end of year cash flows actually look like? Yeah, so cash from operations was down pretty significantly. It trimmed away from the investing cash flows a bit, but not as much as you might expect. Higher capital expenditures, but no acquisitions. Acquisitions is just like a regular item, you know, that makes sense. Free cash flow is cut in half. On the trailing, it says that it's bounced back up about 50%. 50%. Yeah, I don't know. It looks like it might still be a while for AT&T. I don't know. Let me come back over to the liabilities. I assume still okay. Well, so they've improved a little bit in the last couple quarters, but still up just from 2021. It's like definitely be a while for them. Yeah, the divesting process can take a while to get all that pork through the python. Basically, it's like so much extra random charges here and there that have to be thrown off. And it can be very, very annoying waiting through the process. But oftentimes, if you try to wait for the end of the process, it's too late. So, admittedly, it probably is the time to get into AT&T. But I feel like they're grossly undervalued. But I also don't like the fact that their balance sheet is only positive due to goodwill assets. Yeah, see, like I didn't even go to their balance sheet, but I just looked at the liability ratio, and that was like the only part of it I was going to take a look at real quick. But yeah, no, you're exactly. It's like, I mean, that's the thing. I mean, everybody hates on goodwill a lot, but I will say that I don't hate on goodwill as much as some people, depending on the industry you're in. And part of the reason they had massive goodwill, I think it was more acceptable when they had the large entertainment business. Like I think goodwill makes more sense for entertainment. It probably doesn't make much sense now that they've cut back straight to the telecom. So it's like that part makes sense, maybe a bit more sense, I would say, and definitely has been coming down. But in the last year, I don't necessarily know how much of that's related to them cutting off of the value from their telecom assets, or if it's just residuals from the divestment. What goodwill does AT&T have? I mean, fair, but I mean that's sort of the point. It's like it's just a price premium above book value when you acquire things. So the question isn't necessarily about AT&T, it's about the things that they did or did not acquire. Right? But no, I mean you're not wrong. Like it's an ugly balance sheet with a lot of asset that you could argue is basically nothing. So what is this? What is this? I've never even heard of this one. goodwill just irks me because you're not only counting new acquisitions cash flow into your cash flow, you also add it to your goodwill, so it's like a double count. Well, I mean, it's like the present value of the future cash flows. That's kind of like what it sort of is. It's in the sense that the value is supposed to be about the future value. It's like the balance sheet is supposed to represent the value that you're getting. And like I said, it irks me too. I'm more forgiving of it in certain industries, like I said. But admittedly, AT&T is no longer in one of those industries, so I sort of agree with you. Like, it would be more forgiving to me, based off of what I was just reading here, for them to have goodwill, in my opinion. Yeah, let's look at Doyu. Yeah, let's look at something something more interesting. It's like I almost don't want to look at AT&T. It's just like an ugly mess, and I lost money on it, so I don't want to look at it. You know, it's one of those things too. I kid. But Doyu International, together with its subsidiaries, operates a platform on PC mobile apps that provides interactive games and entertainment live streaming for the People's Republic of China. Now, you're already losing me there, of course, but platform connects game developers and publishers, esports teams, players. Is Doyu like the name of their actual app, or do they have? Is it do they have like a group of apps? That's like the one question. Also sponsors professional players and teams, organizes esports tournaments. So more than just the app, they're actually trying to do a little bit more of an organizational thing. Yes, okay. It streams other content to include a spectrum of live streaming entertainment options such as talent shows, music, outdoor, and travel. Further, the company records and offers video clips to allow users to watch replays of selected live stream content. Interesting. So it's like Twitch meets ESPN, kind of. Kind of strange. Take a look at estimates first. Twitch, yeah. It's like Twitch, but with like a more sportsy Twitch. Yeah, twist to it. Although Twitch was always already trying to do sports stuff too, admittedly, but you know, looking like it's doing a little bit of a chill this year. Do you know what's up with the drop off this year relative to last year? Is it like some sort of recurring revenue thing, or is it like a user based thing? They divest something maybe? I don't know. Valuation. Streaming crackdown. Ah, yeah, okay, that's right. That's right. Plus recession. Enterprise multiple 15, 16. Pretty kind of somewhat consistently. You can go back further a bit. It's a little bit lower maybe, depending on if you're included the negative or not. $19. That's a higher interest rate environment back there though, a little bit. Not as much. It's only goes back to 2019, admittedly. So okay. Not super expensive based off of those multiples, but then it gets a little bit more expensive on an EBIT basis more recently. But that assumedly is because of the earnings drop off. So maybe the market's kind of just allowing it to chill. Let's see where. Yeah. So the cash flow from operations is negative right here in these last 2 years, but it looks like it's largely from working capital in the most recent year. The year before that looks a little bit worse. And they're doing repurchases though. What's up with that? It feels like that was a bad move maybe to be doing repurchases. We're doing them consistently too. It's kind of strange. I mean, they did a huge issuance I see back here though. What's there? They have a pile of cash? They do have a pile of cash. I guess it's maybe more forgivable if you have a huge pile of cash. It's still cash burn though, so it still seems a bit dicey to be buying back shares. But I don't know. At the same time, I don't know. If you don't have something to invest it in, it's what it is. Yeah, well, I mean, they're at least have a huge runway. I mean, there's that. They have a huge runway. So it's like they definitely have a lot of time to figure their stuff out. Convert that cash to USD and check MGAP. Oh, you know, I wasn't even thinking currency. My bad. I wasn't even but I mean proportionally. It was still proportionally. That's the thing, is like I was looking at it not even necessarily in absolute terms, but in proportional terms. It's like I was thinking it like relative to the loss. Right. So proportionally, it's still a lot of cash to burn. Check market cap. I don't know. What is the market cap? 370 million. Bruh. Yeah, that's normal. That makes sense. I mean, I don't know. It definitely means that the market doesn't trust it very much. Trust the cash, because that's more than you would need for. That's, I don't know. That's a little weird. What's their user base like? Do you know what their actual user base is like? Yeah, yeah. I know. I mean, it's definitely from the offering, no doubt. I mean, it's like I said, it's just straight up cash burn, because it's like, yeah, they have this huge issuance, and then they're just riding that out. But it's interesting that the market cap isn't accounting for it though, nonetheless. 30th most visited site in China. That's a little strange. Little strange, but I don't know. Not sure I would necessarily want to I don't know. I'd have to look into it a lot. I'd feel comfortable about it. I don't know. Like I said, I'm just definitely have moved into super distrusty camp when it comes to dealing with stuff in the PRC, but I just don't like not having a very good inside understanding of what's going on with their stuff. But that's very strange. It's very strange. And it's definitely not like I said, it's like, you know, there's people have brought up their concerns in relation to the quote unquote cash balances of Chinese companies before, but that's usually about the cash flows coming in. That isn't necessarily usually as much about the issuance. So it's like I see the point of bringing up that it is from the issuance. Like that does kind of make it a little bit of a different situation, but it's still like a type of industry that I don't like that much. Like just online random sites with user bases that I don't fully understand. Got bucked into that fear camp. Yeah, I mean, it probably is. That's the thing. It's like there is so much negativity like that. It's like I here I am backing it up, right? It's like I have those same, like I have that negativity. It's that means like everybody else has that negativity. You know, it's like, but like there might be there definitely might be an opportunity here. This really might just be free cash lying on the sidewalk, but yeah, no, I mean that's the thing. That's the thing about China, is that both statements are true. Like there really is a lot of those scam things there, but China is just so big that it just makes it hard to say, right? It's like the thousand Chinaman parable thing. Literally, it's like just because you say 1,000 Chinese people did something, that doesn't give you statistically useful information, because there's that much more Chinese people than most people. That doesn't tell you anything about per capita rates, right? So it's like, yeah, no, I get you. It's like it's just one of those complicated things where it's like so big, so many companies that you're unfamiliar with, that it's hard to necessarily separate out the real from the legitimate ones. But that actual fear is creating real opportunities. That is true. So it's like this could be one of them. This could be one of them. I just, like I said, it's like I literally had never even heard of this company before. So it's like, wow, I don't know. It's like you say it's the 30th biggest site in China, so it definitely sounds like it's something major. But I don't know. I'd have to see what type of turnover the top 30 sites in China might have too. In 2020, they were going to be acquiring for billions, but the acquisition was shut down by the regulator, by the Chinese regulators. They were trying to they didn't want to be acquired by a foreign company, or were they going to be acquired by another Chinese company? Was it just internal? I see them all the time. Chinese gamers will have their Douyu tag like us gamers have a Twitch tag in their game name. Tencent was going to acquire. Tencent? Okay. Oh, GT's here. Yo. What's up? Showing up late in the party. Yeah, anybody else have another one? I feel like I've kind of said my piece about Douyu. Pull them up on the... Nvidia. I mean, what's there to say about Nvidia, to be honest? Everything there is to say about Nvidia is already said by other people, I feel like. Texas Roadhouse, Schwab. Oh, gang's showing up here. The real question is, do we think that they're going to hit their estimates for next year? That's the real question. Do you guys think they're really going to do 43 billion next year? Or do you think these estimates will be adjusted downward and then they'll hit the estimates? Do you think that's what? Do you think that? Or do you think they will hit it and will they beat? What do you think? What do we think here? No shot. No shot they hit 43.5 billion next year. And then 56 billion the year after that. And then 71 billion the year after that. Are they going to triple their revenue in 3 years? Is that possible? I mean, it's possible, but are they going to do it? I mean, they basically did do it already, right? So it's the thing. It's like, are they going to repeat the last 3 years and 2.5 times the revenue again? That's the real question. Thank you, whoever just threw me a like. I'll ask the rest of you out there, if you're watching live or on the replay, please like the stream. Really appreciate it. If you're not subscribed already, if you're watching live or on the replay, also subscribe to the channel. That way you get notified whenever I go live. EBIT, yeah, see similar growth rates on the expectations there. I mean, that's the thing, is like I would actually almost believe that they would have a 50% increase in their EBIT more likely than I expect them to have another 50% increase in their revenue, because that's just more like operational leverage, right? So it's like I could actually sort of believe that one maybe if they just managed to hit their margins a little bit better. But it's one of those things where it's hard to say. Are they going to repeat the pandemic bubble but at higher dollar values with diminishing pie to sell to? Exactly. Over to the valuation then. Last 3 years. Pretty consistent for the last 3 years. That's pretty it's almost like a nice little oscillator right there. 5 years, it starts to stretch upward, even though the interest rates have been starting to come up during this time frame. Yeah, Nvidia is looking scary, guys. Looking scary. Yeah, they'll definitely be more profitable. It's like that's almost like a much more for sure bet than the ability to have higher sales next year for them. It's like they have so much baked in profitability growth, probably. Just catching up profitability. Well, anyway, let's move on to one of those other ones, Texas Roadhouse. Joseph Carlson favorite. Is Texas Roadhouse going to grow 15% next year? Do we think that? What do we believe it, boys? What do we think? 15% next year? They grew 44% in 2021, and then they grew 16% in 2022. Are they going to grow 15%? Oh, that's not next year. That's this year. So actually, they might be already halfway through that. But are they going to grow 15% this year and then 10% in 2024? How about that? more believable than Nvidia, but you can see it on raising prices alone. Nvidia and Apple are my defensive puts at 5% of portfolio. Nothing crazy. Yeah, not too bad. Both, difficult ones to short. So I mean, best of luck to you. I'm still writing SPY puts in general. Writing, not writing. I should say I'm long SPY puts. So I'm implicitly shorting Apple and Nvidia, I guess you could say, but not as much directly. They're my analog for QQQ puts because I don't see how QQQ drops and those don't. Yeah, I mean, for the most part, it's like when the QQQ finally gives up, that's gonna be those are gonna be the ones that bring it. But I mean, I think it's basically the same for SPY. It's like it's all nested inside of each other, right? It's like the triple Q is basically just nested inside of the majority of SPY, and then those two are just nested inside of that. So it's like you can kind of just like, I don't know, going back to like when I was comparing like different mega cap and AI indices from like several lives ago. Anyway, moving on from the estimates though, let's take a look at the valuation Texas Roadhouse. I know this one's been starting to stretch a little bit to the moon as well. Oof. Well, actually, this valuation had come down over the last year or two, but I'm thinking more like, wasn't it trading a little bit lower? No, it was actually trading at higher. Maybe I'm wrong. Okay, never mind. What do I know? I thought Texas Roadhouse was trading at a little bit of a lower multiple, and that it had kind of boosted its multiple since COVID, but maybe not. Maybe not. Looks somewhat similar. Well, maybe a little bit higher. Not that much higher. It is pretty expensive though, that's for sure. It's either way, it's being given a premium restaurant type valuation nonetheless. It's like no matter how you spell it, that's definitely what it's being given. I'm just comparing it to itself basically, but yeah, comparing it to the rest of the restaurant space, it's definitely expensive. Maybe it'll Chipotle. Yeah, see that's the thing. It's like the thing about restaurants though is that they have a pretty wide divergence in their valuations. It's like some restaurants are given some pretty insane valuations, a la the Chipotles, and then other ones are given basically nothing. Which for the most part comes down to margins, I think. It's like restaurants typically don't get very good margins. They usually have a lot of real estate, which means they're often not super capital efficient either. Some of them are, but some of especially the more real estate focused ones, like the ones that turn into the franchise setup, that definitely helps your cash flow situation, but it really depends. So like Texas Roadhouse looks pretty capital efficient, but they do have not the greatest margins. So they still have the low margins, but it looks like they have a decent capital efficiency. Help back that up. What is Chipotle looking like? What is Darden at, actually, now that you mention it? Yeah, I didn't even really stop to take a look at Chipotle, but I kind of already knew what I was going to find, right? Yeah, okay, so yeah, Darden's at like 1920 right now. So yeah, Texas Roadhouse was chilling in more like the 20 to 25 range. If you go back to 2013 through 2019 kind of time frame, we ended up with more like 15 to 19 for the EBIT versus PE. Yeah, so that's more kind of like typical where you might find it. Let's come back over to the CMG. Yeah, 42.54 over this entire time frame, also including some of the higher points as a little bit of a outlier. But if we kind of take that out, maybe it still has some higher points back in the past, unfortunately. But I don't know. including some lower points as well. 28.44 for PE. So 28 EV to EBIT, 44 for PE for 2013 through 2019 timeframe. We do just stretch it out to include the entire time frame. 34 versus 49. Yeah, super bloated. But let's come over to those financials. Same, not great EBIT margins. Still kind of just in this. I mean, they were pretty good in these years, but here's more typical restaurant kind of range. 13 starting to get pretty good too, but so you can see like maybe why you would get a valuation boost during this time frame or this time frame, but you would expect maybe a little bit more pain in this time frame. Asset turnover is a bit higher than Roadhouse's during these years. It falls like a rock right here. They must have issued some debt or did an acquisition. I don't know what happened here, but some sort of capital structure change of some sort. But then it basically brought it back down to where Texas Roadhouse's was. Texas Roadhouse's was kind of in this range. So much more capital efficient, even with kind of similar margins, you can see. And then obviously you compare that also to growth rates. We have 13-14% expected this year, 13% next year, 13% the year after that. So yeah, high growth, about the same margins, a little bit more capital efficient, equals much higher valuation. Pretty straightforward math there, I guess you could say, to a certain extent. So yeah, I don't know, I guess I'm gonna say that's for the most part, we'll call that it for today. I come to a close here. How can you be at 40-50p with 10 to 15% revenue growth? What the fuck? Yeah, well, I mean, not to say that that was justified. I was just saying, like, comparing it to the other players. Yeah, no, either way, it's still an absurd PE. It's because, you know, I think they're assuming that 10 to 15% revenue growth rate is going to go for like a whole decade. You know, it's like Chipotle is being given the like can expend forever kind of premium right now. So that's where it's at. Where do I have Apple? Where I have Apple? I mean, I'm not great. I don't actually have Apple on my valuation currently, but last time I checked Apple, they weren't super great. I probably could do with upgrading an Apple valuation, but I didn't do all of the big FANG stocks and Apple Plus, FANG Plus, Microsoft, and all them. I didn't do all of them when I made my new dashboard, so I didn't get around to doing Apple and Microsoft yet. I left a few of them kind of off the list. I was planning to do Microsoft here relatively soonish since they had done their 10K. Apple does their 10K obviously in like late October, early November. So maybe I'll wait till then. But the point is I know Apple's overvalued. I know I'm going to find Apple overvalued. I know I'm not going to slap some giant 30 PE on my Apple valuation to make it work well. So the point is like there's almost no point, right? It's like it can wait. It can wait. I'll wait for the annual report and then I'll update Apple. That's kind of my feeling on that. It's like feels kind of like a waste of time for me at the moment, sort of. But yeah, so like I said, this week we'll see where things go. As I said, I'm planning to pretty much update all of my commodity companies that I have in my portfolio currently. I did my Baytex model. Maybe I'm gonna make a video of that. I haven't decided on that. Obviously it's a week until I'm putting that video out, so the point is I don't know, I haven't done any other models recently, so the point is that might be the one I'm doing unless I have some stroke of inspiration here soon. So keep an eye out for that. If you guys haven't watched my more recent videos I did on advanced auto parts, check that out, or Smith & Wesson. As I pointed out the last few weeks, for some reason Smith & Wesson is just getting much less views compared to some of my other valuations recently. It kind of feels like Google doesn't like me talking about guns or something, or maybe people just aren't interested in that stock, but I think they're missing out on something, so maybe you guys should check that out. I don't know. Either way, I'll catch you all next week. Glad you all were here for discussion. Catch you all next time. Bye.